Welcome Rahul Arora, CEO of Nirmal Bang Equities. He's with us in the show. Hi.
Morning.
Feels like old times.
Yeah.
Feels like he's here to anchor.
Yeah, no, I was hearing Latha saying that it's Christmas time. I was like, what are we doing here?
And then
we all
wishing each other happy holidays. That's the part that I really don't
the
get
boys have run away. Why don't you step in as an actor?
Well, I can try. It's been years, but...
No, you better answer questions rather than ask them, Rahul. Well, first up, we have seen the markets off 10% from their highs, or nearly that, from the 26,200 highs. Are you in a stock picking mode at this point in time?
So first off, morning, and thank you for having me, Latha. I think one thing that was clear, Latha, at the highest point of this rally, which was somewhere around 26,500, 27,000, that the market was very overheated. I think if we looked at most of the stocks under our coverage, they were trading anywhere between 1.5 to 2.5 standard deviation over 3 and 5 year mean. So I think nobody would have questioned going into the result season, that is the last result season, that the market was overheated.
Yeah.
Add to that, you had one of the worst result seasons in recent memory, where at least at our brokerage house, 80% of the stocks either were held on estimates or downgraded. So you just had about 20% going in. And then, of course, subsequently, the shocker of a GDP number that sort of came out. So I think, obviously, sentiment has not been the best concluding this year. I think the next 40-45 days will be very important. We kickstart an earnings season in a couple of weeks. We have a new president in the United States, and we've recently put out a report on, what tariff implications could mean for global trade. And then, we have the union budget on the 1st of February, and then, of course, the RBI policy. So I think the next 45 days or so will be very crucial for the market. It's going to be very news heavy. But I think if I was to look at 2025 in totality, Latha, I think 24,000 will be a bit of a pivot point for the market. Plus minus 10% is how we're probably going to, spend the year. I think the recent high of about 26.5, 27,000 will be the peak for next year. I don't see the Nifty falling more than, say 21, 22,000. So it's going to be a broad range. But as you rightly pointed out, Latha, that doesn't mean stock picking opportunities don't arise. Even right now, there are enough and more opportunities that are being thrown up. But I think as we enter the next year, we should have slightly tempered expectations, because let's not forget the last 5 years have seen the Nifty go from 7,500 to 27.5. So I think to some level, having some measured expectations is not a bad way to enter 2025.
And what are the themes that will dominate the narrative next year?
So I think this is probably a consensus call that you've heard, Reema, but I think the biggest overweight is BFSI. I think, unfortunately, the elephant hasn't moved. I think FY26 is going to be a relatively softish year, because I was looking at, we've just put out a very detailed thematic on deposit growth and looked at how it's panned out from independence and when credit and deposit growth, kind of converges, and it's kind of converged right now. So FY26 may be a bit of a challenging year. An odd ICICI bank may outperform, an odd federal bank may outperform, but by and large, you're probably looking at 10 to 13% kind of NI and PAT growth for most banks this year. But I think as the year wears on and you start factoring in FY27 earnings, most banks are trading between 1.5 to 2.5 times price to book. That's nowhere close to where they have traded at their peaks, where they were trading between 2.5 to 3.5, and some banks even 4. I think if you get into a situation where you're looking at 15% plus kind of operating profit growth, BFSI will come back sort of to lead. The one sector I would completely avoid would be consumer staples, I think, at this point in time. So I think, any money that you have towards consumer staples can be moved here. And I think that the joker in the pack, as I was alluding to Latha in my first answer, could be IT services. I know it's had a good run, but I think if the US, the one call everyone in the world has got wrong for the last 2 years is the US recession. People have been writing about it, and not just sell side, buy side consulting firms, BCG, McKinsey. I mean, you pick up any, pretty much everyone's got it wrong. And I think the resilience of the US economy has helped. I think, and the last probably place, I think, so BFSI, IT, and I think consumer discretionary. I think these will still be the three themes to play out, and probably go underweight on consumer staples. That would probably be my broad positioning. And I think because government capex is going to be in the center of everything as we sort of approach the budget, I still think manufacturing and capital goods related sectors could do well, albeit valuations are not really cheap. But I think at least from a growth perspective, that sector could hold out.
So, Rahul, the thing is, for large cap BFSI and for IT to do well, these foreigners, they have to stop selling 90,000, 30,000, 40,000 crores worth of Indian equity on a monthly basis. And that goes back to the other point that you're making, this extreme strength in the US economy and the fact that this great buy home, buy, go home, buy America trade, that's been the hallmark of the end of 2024. But what do you hear in terms of the chatter when you talk to your sort of circle around you? In terms of the extent of this FPI selling, can we hope for it to reduce at least somewhat?
No, I think some clarity may emerge, Surabhi. And I think, when we had done Editors Roundtable a few weeks back, I had said that, the only economy that I see India competing for capital with in 2025 is the United States. I think on a relative basis, the fact that China still feels the need to stimulate its economy, and see, a lot of capacities have moved to India on the manufacturing side. I don't think we're living under any delusion that China plus one was going to pay out in a magnanimously big way and everyone's going to move manufacturing here. It's played out in a limited way. You've seen that in durables, you've seen that in electricals. I mean, someone like a Vivo announcing such a big deal with Dixon just about a week, 10 days back. So that process is on, I think. You are competing on a manufacturing level with something like a Vietnam, which is allowing 10-year tax holidays. That is something that India hasn't gone down the road and done yet. But I think from a straight FII perspective, you're probably competing with the US. On an FDI perspective, maybe Vietnam can be added. But my sense is, Surabhi, I think if, you have relative stability in the US markets from here on, I think the fact that Trump has come back, and I think, if you go back in history and as far back as you want, typically a democratic president has always coincided with global conflict. It's quite interesting. And a Republican president has actually coincided with stock markets doing well, partly because, most of the banks on Wall Street even today, are pro-Republican and are Jews. And I think, that's why they particularly take a stand on Israel as well. So I think it's going to be a pro-market government. And I think if that is the case, I think even if India manages to grow at 6%, at some stage, I think it is just a pro-Trump trade that's taking it there. Sorry for that tongue twister. But I think that's probably what it is. Obviously, the rupee has also seen a resultant impact of that. But I'll go back to a very small anecdote and I'll conclude my answer with this, Surabhi. I think, in 2008 post-Lehman, I remember that year, FIs had pulled out about $20 billion from Korea, and the Kospi was still up 10%. And we used to ask ourselves, when will India reach that level where FIs would sell and the markets would still be positive? Given the selling numbers that you've seen, if we didn't have a 70 lakh crore asset management industry in India, the Nifty would probably be at 15,000 or even lower. So I think there is that absorption part. Of course, the other thing that's hurt our markets from an absolute standpoint is that a lot of IPOs have come through. So there has been some liquidity that's moved from the secondary market to the primary market. There have been some very big ticket IPOs. So that's also put some sort of a cap. But I think all of this will find its, the water will find its level. And I would not be surprised at some stage if we made a move towards the previous heights.
Rahul, stocks. You have BFSI and you have consumer discretionaries and IT. Which ones in these three sectors? Okay,
so let me try and make a model portfolio for you. I think if you look at banks, I think in the large caps, we'd probably stick with SBI and HDFC Bank. I think those would
not
be...
ICICI.
ICICI Bank is a consensus call, Latha, and I think it's trading at 3 times price to book. So I think on a relative basis, the delta...
HDFC Bank.
I think, is probably where it's at. I think you could look at an AU and a Federal, I think, in the mid caps. I think AU will probably grow at about 25% plus. Their cost to income ratio is going to drop down dramatically, which is going to aid profitability. So that's on BFSI. I think we can add ICICI approved life insurance to that. I think that would probably be. And one stock that you probably don't discuss very often, Latha, would be HUDCO, Housing Urban Development Corporation. That's sort of on the BFSI side. On the consumer discretionary side, since we're talking Christmas, let's start with an alcohol stock, United Spirits. We love that name. I think there have been a lot of regulatory changes in Karnataka, a lot of route to market changes, which could potentially give us an upside risk to our numbers by about 15%. So I think UNSP could be one, Chalet Hotels could be another, and Westlife could be a third. I think if you're playing the consumer discretionary basket, and like I was talking about manufacturing a little earlier, I think we'd play defense through some names like, say, Hindustan Aeronautics and BEML. I think those are some of the names that sort of come to mind immediately. Apart from that, I think it's very stock specific, Latha. I think we'd probably stick with LTIM and Coforge. I think Coforge will still give you about a 20% growth in the next financial year. I think there are still some levers. In fact, we recently met the management and upgraded our numbers. So I think, and I think if you want to go down the value chain, Reema, I think Birlasoft could be another one. I think it's been a bit challenging, but I'm not sure how many of these names are actually actively discussed on the channel. But these are, you need to find new ideas to give people all the time. But I think those are some of the names that that we would look at in IT. Coforge would be the top bet, followed by LTIM and then Birla Soft.
Coforge has given a fantastic return of 45% CAGR over the last 5 years.
Let me put it into perspective, Reema. When we went into the lockdown, Persistent went in at 400 and came out at 3,600. So it was a 9-bagger in 2 years. So past performance...
Persistent's 5-year CAGR is 80%.
Exactly. So I think if you are let me give you one of the best examples that I love talking about is Dixon Technologies. I think if you look back over the last 10 years, the company has grown its sales, operating profit and PAT compounded by 35 to 40%, at a 35-40% return on capital employed and a nearly 4% EBITDA margin, and look at what's happened to the stock. I think if you're able to give those growths, I often call Dixon the Nvidia of India, because the way it compounds, the valuations don't look out of whack when your EPS is growing at that level. So there are opportunities.
So there are opportunities. So let's end with the consumer, because that's a sector that historically you've always looked at so closely. And I know that you said that staples are not a place that you'll venture in. And I think the reasons are very obvious. When 3-4% kind of growth, does the market really want to go there? But at the same time, India is consuming in very different ways. I mean, the hotel stocks, the spends over there, travel, tourism, the discretionary part of it. Any stock on consumption which kind of tries to, maybe a Zomato, Swiggy, I don't know, anything that tries to capture where the money is being spent, because it's being spent. Look at all around us.
So, Surabhi, at your CNBC event just a few weeks back, you all hosted the Swiggy CEO on the day of his listing. And I remember the sensex was down 1,500 points that day, but Swiggy was up 20%. It was remarkable that a company that was making 2,500 crore losses was having a 20% up move on a day when the sensex was down. I think a lot of the trade has moved to aggregators. You've seen Zomato move from 40 to whatever it is today. You've seen that happen in Policy Bazaar as well. But I think, Surabhi, the way I would look at consumption today is, as I was talking about the Nifty, look at 5% volume growth as the mean. At bad times, this will drop to 2 to 3%, maybe even 1%. And at good times, about 7-8%. You combine a little bit of pricing and premiumization and you get about a 10-11% kind of growth. Now, at that, do you want to be paying 45-50 times valuation is my only limited point. And I would not be comfortable doing that very clearly. I think the only FMCG consumer staples names I would probably look at is where there is a food component to it. I think that could be an interesting one. So maybe something like a Britannia, Tata Consumer and a Nestle. I think those could be interesting names to look at, but predominantly hardcore consumer staples names like, say, a Lever or a Godrej. And you've seen the commentary around Godrej. I mean, it was a shocker. I think just those I would probably still want to, stay away from. And, as I was talking to Latha earlier, I've already listed some of the consumer discretionary names that we like. But Swiggy looks like an interesting one. I know one of my competitors has put out a note with a 700-750 price target. Two
of them, actually. I think there are two foreign brokers, but not words of 700. So JP and Sales.
And I think a lot of it is quick commerce related. And I think that looks like a very, very interesting space. I think the one thing that's changed for a lot of these companies is when you go back to when these companies started listing, and I remember doing a show with Latha at that point, I think in the peak of, when these new gen companies were listing, terms like price to sales, client addition, GMV were the big thing. I think now they have understood the business. They're talking about, ROCs, they're talking about return to profitability, they're talking about cash flows, and that's why you're seeing these stocks re-rate. So I think that sanity has creeped into that side of the business that, theek hai, mera itna loss hai, but let me at least guide towards profitability and take the investors along. And I think that's what people are paying for.
Every time I click buy on the cart, I just look at the 10 rupee platform fee, the small cart fee, and all of those fees, and I still click buy, right? I mean, that's a habitual change.
So what I do is I see like, delivery is being charged. I need to spend a little bit more to save on the delivery. So every time I have to save that, 20, 30 rupees, I have spent like 200 rupees.
But thank you.
Thank you, Rahul. We have to call it a day because we have a very big company joining us. Maybe you want to listen to that conversation. We're going to be joined by Jairam Sampath of Keynes Technology in just a minute after this break. Have a brilliant 2025 yourself.
You also, Latha ma'am. Thank you so much. And to your entire team. Thank you.
Happy New Year.